funsupermart.com.
Many investors may have been concerned with China having a hard landing, meaning that growth would suddenly slow down significantly. Since third quarter economic figures have recently been published, in this webcast we will discuss whether China's economic growth will continue to slow. Figures published last month indicate that third quarter GDP growth slowed to 7.4%, which is the seventh consecutive quarter of slowing growth and even hovers below the government's official growth target of 7.5%. While there have been evident signs of a slowdown, some may wonder why the People's Bank of China hasn't done even more to support economic growth. In fact, the central bank has not cut interest rates or reserve requirement ratios since the start of July. We think the main reason for this is because inflation and property market risk are still a threat to the Chinese economy. That said, the central bank has continually conducted reverse repo operations in order to increase short-term liquidity in the markets. Through these operations, since June, the central bank has injected a net amount of liquidity equivalent to 350 basis point cuts in RRR. But in fact, we don't think that the economic situation in China is all that bad, as economic growth in the first 3 quarters of this year still managed to maintain at 7.7%. Plus, economic figures published in October indicate that the economy is starting to stabilize. In particular, exports growth rebounded to 9.9%, which marks the third consecutive month of improvements. On the other hand, looking at exports to specific regions, it was a rebound in exports to US and Asia which boosted the headline figures. Exports to Europe remains weak, however. If we look at other main drivers of economic growth, we also saw investments growth in September improve slightly. Retail sales also rebounded to the highest rate of growth seen since March this year. Even though these figures are not outstanding, at least we didn't see any of these 3 indicators decline any further. As for the equity market's outlook, even though GDP growth slowed to 7.4% in the third quarter, markets' reaction to the news was relatively optimistic, leading the Chinese equity markets to outperform all other equity markets under our coverage in October. As the economic outlook starts to improve and the central bank continues to loosen policy, these 2 factors will provide the equity markets with an upwards momentum. Finally, valuations and upside potential remain attractive. Therefore, we think that it is still a good time to consider investing in China.